All right, we're going to go ahead and get started. Good morning. My name's Tom Bayer. I'm a partner with Sikich in the Indianapolis office. And welcome everyone. I got a couple housekeeping items. I have with me today Glenn Birnbaum, who is a partner in the Peoria, Illinois office, and Jim Brandenburg, who is in the Milwaukee office. So good morning, Glenn. Good morning, Jim.
Morning, Tom.
Good morning.
So a couple housekeeping items here. You can submit questions via the question feature in the webinar control panel, so please do that. We'll try to answer those. If not, we'll follow up after the webinar. We will launch some poll questions throughout the webinar. We have 3, so you please look for those and answer those. They're required to be completed to get CPE credit for those of you who want CPE credit. You can download the presentation slides from the handout section if you'd like. The webinar will be recorded and sent out for on-demand access after the session, so you can access that again, or if you missed part of it. And at the conclusion, we'll launch a short survey, and two will need to be completed for CPE. And then those CPE certificates will come out 2 to 3 weeks after the program is over. So we plan to briefly touch on topics, and today some of which we've covered in previous webinars, but new information's come out on some of these topics as we get close to the year end and kind of think about year-end tax planning. So with that, I'd like to go ahead and jump into the program today, and I'll invite Jim Brandenburg to start us off. Jim.
Good, thank you again. What we're going to do is get started here. Again, we're going to do some legislative developments for some economic investments, some reporting items, and then some other miscellaneous items that we're going to cover here today. Again, some strategic tax planning for this 2022 year with it. First, we'll get started with some legislative items that Glenn's going to cover as far as this Inflation Reduction Act this summer, just an overview of the bill and some energy provisions. Glenn?
All right. Well, thank you, Jim. Yeah, we're going to, again, I'm Glenn Birnbaum. I'm in the Peoria office, but we're going to talk here first about just a little bit about the Inflation Reduction Act. This was passed, I believe, back in August. So just kind of some quick hitters here. You know, there is this 15% corporate minimum tax. This really applies, to really large C corporations primarily. There is 1% excise tax on certain stock buybacks, a 2-year extension of kind of what we call the large loss limitation under Section 461L. We're going to touch on the IRS enhanced enforcement. There's been some additional dollars allocated to the IRS to help with enforcement. And then I'm going to talk a little bit about some of the energy provisions, because obviously a lot of this Inflation Reduction Act, has things in there for electric vehicles, solar, all sorts of things, carbon sequestration. So let's move on to the next slide. Jim, thank you for preparing this slide. It's kind of a nice summary of, what, if we might remember, what was potentially going to be in, the bill, Ways and Means, what they originally had in there, things like basis, maybe we're not going to get a full basis step up. We're going to have higher capital gains rates, all sorts of things. And you can see as you, move to the right there, that, again, a lot of these things didn't end up in the bill. So just kind of a little reminder about how things were. Really, I think it started in April of 21 when we really thought, for sure capital gains rates are going up and this kind of thing. And again, most of this stuff ended up not getting passed and put into law. All right, so yeah, let's go to the next one. This certainly got just a little bit of press. The IRS enforcement, there's additional dollars that's going to be put to enforcement, $80 billion. If you look down there, $45 billion for, not just for audits, but for other types of activities, enforcement activities. But there is $25 billion that's for operation support. There's $6 billion to help with technology modernization, $4 billion for hopefully some increased, taxpayer service. So again, fair amount of dollars. And on the next slide, we talk about, this is where, we got some of the quite a bit of press about, are these audits going to be just for people making less than $400,000? That's the bill kind of says, we don't intend for these things to impact those making less than 400,000, but they're really, don't believe there's really any assurances of that. So ultimately, it's going to be difficult for the IRS. They do have, like a lot of industries, it's estimated that 40 to 50% of the IRS personnel will be retiring in the next 5 to 10 years. So, going to be a lot of turnover, and how are they going to manage and, hire people, find people to do this enforcement? But again, a lot of industries are in the same position. So definitely some challenges for the IRS coming up, but there's going to be more dollars allocated to this enforcement, and it is going to have, an impact as we go forward. And obviously, we need to make sure we document things and, be prepared for audits, because there is going to be increased audits, we believe. All right, so yeah, these next couple slides, we don't have time to get into all the energy provisions of this bill, tons of things. Things are expanded, extended, right? If you look on the next slide, a ton of the IRS is seeking comments now on a number of things. This bill was passed in August. And on the next slide, we show, all these different notices that were issued on October 5th, requesting comments on the prevailing wage rules, all sorts of things. And most of these have I believe, a 30-day comment period. So we are in that window for comments. Okay, so let's go to the next slide, Tom. I just thought we'd kind of maybe focus on one type of credit, the solar credit, both residential and commercial, because this is a credit that's been around. So some of this is kind of a refresher, but this will kind of illustrate what's changed with a credit that maybe, many of us might be familiar with. So it is under Section 25D. So we're talking the residential solar credit here. This is for just a person who's going to put these solar panels on their personal residence. Credit is a non-refundable credit, nothing changed there. So what did change? Well, we've restored the credit back to 30%, and that starts in 2022. So it's really retroactive back to January 1st of 22. The credit 30% is going to be through 2032, and then it does drop to 26% out way into the future. But for those of you that might remember, the credit was 30% years ago. It stair-stepped down to 28, 26, and it was going to keep going down. So again, what's different is it's back to 30. Other things are that there's more items that might qualify for this 30% credit. One of them being something called standalone energy storage. And this is for expenditures started in 2023. And what would be an example of this? It would be batteries that you've purchased. Now, they're not connected to the solar panels, but that would now be eligible. So what's the concept there is, well, I could store energy in these batteries and then use that, when energy is at peak demand and at higher prices. So I could actually, keep my energy costs low by using the energy that's stored up in these batteries. So just again, a quick example of what's changed on the residential side. Now, Tom, if we move to the next slide, that's the commercial side, commercial solar credit, and certainly we're seeing lots of interest here in Central Illinois about, businesses looking to put solar panels up. So what do we have going on? We have a 30% credit still. Now there's a couple caveats to that, but it's a 30% credit. Again, it's in 2022. But now this credit is really going to be only in effect for 22, 23, and 24. And then in 25, it gets quite a bit more complicated. It's actually under Section 48E, and you get into something called technology neutral credits. And we don't have time to get into it, but there is additional intrigue, I guess, shall we say, in 2025. Okay, let's just do a quick, just a reminder about why, because I think if you do the present value on some of these credits, it can be pretty significant. And so why is this? Well, you do get this 30% credit off the top, but these items are depreciable, right? So, and the nice thing here is that our depreciable basis is only reduced by 50% of the credit, not 100% of the credit. So as an example, if I put up a $100,000 system, a business does this, puts up a $100,000 system, they get a $30,000 federal tax credit. Their net cash out of pocket, right, is $70,000. but you get to depreciate 85,000, right? So I'm getting a $15,000 deduction that I don't have to pay cash for. That helps quite a bit. There's obviously also state, there could be state credits and rebates and things. So again, when you do the present value on some of these projects, they can be rather attractive. Now I mentioned it's 30%, but it does have the potential to be reduced by 80%. So it really would go back down to like a 6% rate if these wage and apprenticeship requirements aren't met. As we talked about just a few minutes ago, these wage and apprenticeship guidance, it's not out yet, so we don't know what the rules are going to be. There is the provision in there that says, well, as long as you begin construction within 59 days of the release of this guidance, you're going to be okay. So that will be interesting. Depending on what the guidance says, there'll be kind of this roughly this 60-day window. The other thing is there's even a potential bonus. You get an extra 10% credit. So the credit could go from 30 to up to 40%, and this is for 2023, starting in 23, if certain domestic content requirements are met. So again, pretty significant. We're seeing a lot of interest in this within our client base here, particularly in Central Illinois.
Okay, well, let's do the first poll question, Jim.
Okay, we've got our first polling question here. Thank you, Glenn. First poll question is, do you plan to take advantage of any of the new energy credits that were passed in the Inflation Reduction Act? Yes, no, or unsure. And we did have one question as you're answering that polling question. It asked about, can nonprofits sell their solar credits to taxable entities? And again, I think that we'll have to wait to see the rules come out. There were one of the key parts of these energy provisions is that the credits or grants or incentives that companies get for a number of the energy ones will be able to be transferred or sold, whether it's from a nonprofit to a profitable or even from two, let's say profitable entities. But it varies across some of these different energy credits and incentives that were added. So something to keep an eye on when those rules come out as to how and in what situations that you can actually sell or transfer those credits. So we'll have to watch for that, but there is an opportunity. I just don't know specifically if the solar one falls in that. So anyway, great question. Okay, let's check our results on this first polling question. We've got no 14%, 48%, or yes 14%, no 48%, and unsure 38% for it. So again, I think some of those, again, once some of the guidance come out here, I think we'll see what may take place with some of these credits here. So thank you for that poll. Okay, our next topic here we're going to look at is some other legislation. It's not something that actually passed this year, but it actually passed in late 2017 with the Tax Cuts and Jobs Act. But these next three items are actually ones that have a big impact here in 2022. So we're going to touch on that. The first is the research expenditures under Section 174. And again, up through 2021, research expenses can be deducted in full in the year that this was incurred. Again, this is the deduction side of it, separate from the research credit under Section 41. What the Tax Cuts and Jobs Act did, though, is that starting in 2022, instead of currently deducting those research expenses, those need to be capitalized and they're amortized over 5 years. And then further, what they're doing is you get a half year, they call a half year convention for the first year. So in 2022, you're only going to get 10% of those costs, and the rest of it, 90%, will get capitalized, and it's going to get spread out again over the next 5 years, actually going into a sixth year. So that's going to be a significant impact for those that have research expenses. Next slide here, Tom. Here's an example here. We've got a manufacturer, again, spends $1 million on research expenses. For the 2022 year, it's got $1.5 million of taxable income before that research. Again, they only get $100,000 allowed, so they have $1.4 million of taxable income. If they had the same thing last year in 2021, it would have been $500,000 of taxable income. So again, $900,000 of higher income. Again, they'll spread that. They're going to get it over the next 5 years, but it's a significant impact for them for the 2022 year. So again, what you could get is some companies that maybe haven't adjusted for that. They may be short on some of their estimated tax payments here in 2022. Again, that's a significant swing. 90% of what had been a current deduction is going to be deferred with it. Again, in the past, this wasn't that much of a difference. Again, a number of these expenses, between a Section 162 ordinary or a 174 R&D ones, they both were currently deductible. So that distinction between what was R&D and what was ordinary business expense really didn't matter. Starting this year, it'll matter again, that the R&D one gets capitalized, whereas a 162 is currently deductible. There is some support in Congress to delay or defer this effective date. Both the Senate and House are in support of that, so it could be part of any end of the year legislation, perhaps after the November midterm elections, but there's no guarantee with it. So until that law changes, I think that's something to be aware of, and anticipate that you're going to have to capitalize those. If it does change and it's in your favor, then you can adjust accordingly, but just be aware of that. And again, the effective date for this, again, is for tax years beginning after December 31st, 2021. So if your calendar year, again, 2022 is the first year that you're going to have this research impact. Next one, another one here, again, also from the Tax Cuts and Jobs Act that relates to the interest expense limitation, again, under 163J. Again, this has been out. A number of you had to deal with this over the last couple of years, but there's a significant change here in 2022. Next slide here, Tom, with it. One of the things that you do when you go through the calculation is come up with what they call this adjusted taxable income that you take 30% of, and that's how much interest you can deduct. But one of the things that was part of adjusted taxable income in the past was your depreciation and amortization deductions. You added that back again, made that adjusted taxable income higher, made that interest deduction higher, that threshold. Starting in 2022 here, however, depreciation and amortization are not added back into that. Okay, so again, that's going to apply for, again, tax years beginning after 12/31/21. So again, for calendar year 2022 is the first year for that. So you couple that a lower limitation with higher interest rates. Again, the current conditions are with higher interest rates this last year, companies are probably going to have more interest expense. You're going to have potentially more interest expense on the one hand with a limitation that's going to allow less of that to be deducted. That's going to be a big impact, I think, for some companies this year. And there hasn't been as much discussion with this item as far as delaying the effective date as there has been with the research expenditure that we talked about. That could happen, but we just haven't seen as much discussion with it. We have an example here. Badger Inc. is a manufacturer, has $1 million of interest or taxable income before its interest deduction, and it has depreciation and amortization. You can see totaling $2 million, and its interest expense was $600,000. And then for 2022, it has the same thing, same items, except its interest expense went up with the higher rates up to $900,000. So let's see what happens on the next slide here. You can see what the impact is. Again, for 2021, the company Badger was able to fully deduct its interest expense. Again, the adjusted taxable income was at the $3 million times the 30%. They were able to fully deduct that $600,000 of interest expense. But for 2022, again, we don't add back that depreciation and amortization. So their adjusted taxable income is $1 million. 30% of that is $300,000 is all they can deduct. So there's going to be $600,000 of disallowed interest expense that they will have for the 2022 year. So quite a change that you're going to see here again for the 2022 year. Okay, and the last one, just to mention, again, this was another change from the Tax Cuts and Jobs Act dealing with bonus depreciation that many of you are familiar with. Again, it's 100%, again, for new and used equipment that came about. Again, this is separate from Section 179 that has a annual expensing that is $1 million index for inflation. I think it's about $1,150,000 somewhere in there now. Anyway, for the bonus depreciation, you can see the schedule here. This is what's scheduled to change. So it's still 100%. It was 100% last year. It's 100% for all additions through 2022. But then starting in 2023, you can see it drops to 80%. and then down to 60, 40, and 20. So it starts gradually going down over the next several years. So just be aware that, that change that is coming here. On the next slide, you'll see here that the one thing to note with this is this effective date is what I put down as a date specific. It's not based on your fiscal year. So it's any additions that you make by December 31st, 2022 get the 100%. If it's after that, it's going to drop down to 80%, regardless of what your company's fiscal year is. So if you do have any major fixed asset additions that you're looking at here in the fourth quarter of 2022, and you want to make, and you're trying to get that bonus depreciation, again, make sure you get that placed in service before the end of the year to secure the 100% bonus depreciation. Again, have not seen any, since it really starts affecting in 23, if you will, it drops down to 80%. Haven't seen Congress talk about delaying that effective date on the bonus depreciation. It could be part of some year in the legislation. I just haven't seen as much talked about that, again, compared to the research item. So again, something to be aware of for any of you who are looking to put in some major additions this year to get those in before the end of the year to get the 100% bonus depreciation.
Jim, I think the other thing to kind of important to point out here is that the rules on when you can use bonus versus Section 179 are a little bit different, right? If someone has a rental property that isn't considered an active trade or business, the bonus is really available, whereas 179 may not be.
Correct. There's some similarities with it. Obviously, there are some, as you said, some differences. So just make sure that you're aware of those. And if you do have, again, some major additions that you're looking at, again, try to get those in place and in service before the end of the year so that you can get that 100%. And again, it doesn't matter what your fiscal year, it just looks at the date that you put that in service.
Okay, Jim, we're on our second poll question here, moving right along. So you want to read that to the audience?
Sure. Okay, of these Tax Cuts and Jobs Act provisions, concerns you the most here for this year in 2022? Is it the bonus depreciation change we just talked through, the R&D expenditure under 174, the interest expense changes, or something else that is in the Tax Cuts Act there? So again, if you could go ahead and answer this poll question here.
Okay, give them a couple more seconds here and we'll read the answers.
Okay. Okay, looks like we've got bonus depreciation, the interest expense changes really almost tied there as far as the top two responses, 36, 35%, and then a little less on the R&D one. So again, something to watch here with it. Again, all these items I think have received a little less attention this year. A lot was devoted to this Build Back Better or this Inflation Reduction Act and some of those changes and some things that happened or didn't happen. These other ones were in there, and again, all of a sudden took effect, and people have to deal with it. So it's good to see that at least some are focusing on these items. Okay, thank you.
Thanks, Jim. I'm going to cover a couple other provisions here, just things to think about as we approach the year end and things to keep in mind. First one is obviously the market, and our portfolios have generally taken a hit this year with the market declines. We've had some recently, the market's come back a little bit, but remains to be seen where it ends up by year end. So, one of the things we could think about is if we have, some losses in our portfolio, and we can harvest those and potentially offset those losses with maybe some stocks that or investments that have some significant long-term gains in, even though they may be down this year, it may be a good time to harvest some of those losses. You're limited to a net of a $3,000 long-term capital loss. So as you net gains and losses, anything over 3,000 would be carried forward, remember. And then just a reminder that there is this wash sale rule where you know, if you sell a stock at a loss, you can't repurchase that stock or anything substantially similar within 30 days after the sale. So you can't you know, harvest the loss and then immediately get back into that stock. And by the way, you can't do that within an IRA. In other words, you have a taxable investment portfolio, and you sell a particular stock, and then within an IRA, you have the ability to repurchase that stock. You can't do that either under Rev Ruling 2008-5. So, you know, think about harvesting losses, but remember that those wash sale rules are out there. If you intend to hold that stock again, you've got to comply with those rules. Cryptocurrency is a continued hot topic. You know, as we know, they've come out with some new laws, and the regulations are being sort of bantered about within IRS. Some real controversial provisions within crypto, you know, reporting of cryptocurrency and treating it like it's cash and so forth, and could be some real burdensome regulations coming out. But in general, nothing has really come out that from those laws for the most part. And one of the things to remember here is, you know, cryptocurrency losses, you know, you don't have the wash sale rules with cryptocurrency. So there's no 30-day period to be concerned about. You know, as we note here, most of the crypto, if not all the cryptocurrency types are really down. Bitcoin's down 58% this year, 68% if you consider from the beginning of you know, 2021. So really big declines, and you can again harvest those losses as well. But you know, look out for you know, in the future they may have some of the same rules that you know, stocks and bonds have, specifically the wash sale rules. I'm going to flip over to a kind of a business provision, a planning provision that really relates to businesses. So the crypto and the wash sale rules and of course harvesting losses really is more of an individual tax provision. One of the provisions that we try to talk to clients about, especially in the context of, you know, potentially selling their business or selling either assets or stock in their business, is this code section 1202. And just want to make have a couple slides in here, make everybody aware, remind everybody of what 1202 is. So 1202 is for what's referred to in the tax code as qualified small business stock. Okay, it must be, and it really is for if your business is operating as a C corporation or formed as a C corporation. That's really where this comes into play. It's a very, very complicated area of the tax code. So, but it's one you need to have some awareness of, because as we think about you know, business owners that are clients, as we think about selling our business, we really want to take a look at 1202 and whether or not it could apply or whether we could plan for it to apply. And so, you know, the topic of this webinar today is strategic tax planning. This clearly is something that is strategic and you need to plan for. So let me just go through a few of the provisions. This has evolved over the years. Okay, so it really came into play in 1993. We're going to focus on the most recent changes to 1202, which was in 2010, which made permanent this 100% gain exclusion. Okay, so C Corp stock, if you sell your you know, closely held company, and it's a C Corp and it meets all of these you know, requirements, it's possible that the entire gain is exempt from tax. Now, what is excluded? Well, it's limited to $10 million per taxpayer, or 10 times the aggregate adjusted basis of the stock. and that's measured at the time of issuance, whichever is greater. So that sentence alone is complicated, right? So you really need to sit down with a tax advisor to understand this. But the point is there's a pretty big tax break here, an opportunity to have a big tax break from Section 1202. So a stock, one of the things that is probably not widely known is a stock sale includes a liquidating distribution. So in other words, a lot of times that we sell our business, the buyer wants to buy assets. Why? Because of things like bonus depreciation, right? They can get tax basis in those assets, and they can get an immediate write-off, and that write-off helps them sort of reduce the purchase price, right? Because they get a cash benefit, immediate cash benefit from the tax deduction. So asset sales followed by liquidation potentially qualify for 1202. Okay, now there's a lot of other requirements that you have to meet, but we'll go through some of those. But frankly, you don't have to sell stock. You could have an asset sale followed by liquidation. There's also, and we'll go through these real quick, there's a small business requirement you have to meet. It has to be an active trader business, and there's an original issuance requirement. So let me go through these fairly quickly. The qualified small business stock must be issued by a domestic C corporation with cash and other assets of less than or equal to 50 million. So a relatively small business at the time of the issuance, okay? The assets are measured as cash plus the adjusted tax basis of other assets in the corporation. So a relatively small business, again, at the time the stock was issued. If it grows beyond that, you still may have qualified small business stock. So it's really at the time the stock was issued. It has to be an active trader business, okay? So it must have at least 80% of the value of the corporation's assets must be used in a qualified trader business, okay? Some businesses are excluded. You can see a list here. Unfortunately, accounting firms are in that list, Jim. But basically, manufacturing, construction, what I refer to loosely as GDP type businesses, technology, sales, retail, all those kinds of businesses qualify. So, but some don't, right? Farming, banking, professional services in general. But you'd be surprised what does qualify. So there have been some recent rulings come out where some businesses did qualify that you wouldn't normally think would. So similar definition, if you're familiar with the 20% QBI deduction, similar definition of what qualifies. And then original issuance requirement. Again, a shareholder must acquire the stock for money, for property, or compensation. Okay. It could be from a gift as well, right? You may inherit qualified small business stock. It does retain its nature as qualified small business stock if you inherit. So you start to see all of the requirements around this, and it gets pretty complicated. So you have to carefully look at this. So can you qualify if you're not a C Corp? Yes, you could. You're going to have to basically become a C Corp. But again, this is where we get into, let's look forward and think about the exit strategy of our business. And we can plan to use this provision. Now, I will warn you, Glenn showed a slide earlier, this provision was in a couple of the proposed bills to be terminated, right? Like 1202 stock sales after a certain date are no longer eligible for this exclusion. So, the tax law change is always a possibility, but so far it hasn't been touched. And can more than 10 million of gain be tax-free? Again, yes, there are some planning opportunities here. And remember the 10 times basis provision that I mentioned earlier. There are ways to get more than 10 million per taxpayer excluded. Obviously, the other thing you could do is some gifting. So It's a really, really exciting opportunity if you're looking at exiting your business, but it's one that takes some careful planning. So I'll flip back over to Jim to talk about another exciting topic, LIFO.
Thank you, Tom. Appreciate the update on 1202 here. LIFO, again, this is nothing that's new. Again, we talked about some recent tax law changes with it. LIFO has been around for a long time here, and but its application is more practical for this year because, again, of the inflation we've had this year. Next slide here, Tom, with it. Again, some of you may be familiar with LIFO going back maybe when you were in the business school or accounting. Again, LIFO, last in, first out. Again, it's been around for a while. Many companies may be more familiar with the FIFO, but LIFO is still available. And again, it treats the most recently acquired products as being the ones that are sold. Again, it matches current cost with current income with it. Next slide, Tom. Again, FIFO is the opposite. Again, gets the older cost treated as sold. LIFO is the opposite. Both are acceptable methods. So again, when you're looking at it, you're going to look at one, say you can use either method with it. Again, which one's going to give you the better results, or at least from a tax standpoint. One thing just to note when you see it on a company that is on LIFO, the difference between the FIFO and LIFO on their balance sheet, you'll see is what they call the LIFO reserve. Again, that'll show you what the cumulative amount of differences that a company had that's on LIFO compared to what its current costs are under FIFO. Next slide. Okay, as products rise, again, the use of LIFO, again, ends up reporting less income. It doesn't really affect the company's cash flow. The only thing that affects part of the cash flow is, since it drives down the income, the company's paying less tax. It actually might improve the company's cash flow, but it doesn't have a direct impact on a company's cash flow, except to the extent that the taxes are lower with it. So, what the use of the LIFO method for tax purposes really is as inflation continues, as you build up the what they call your LIFO reserve we've talked about, it's really an interest-free loan from the government that not only is a loan, but it can continue to grow as long as you've got at least some level of inflation with it, and there's no interest cost on it. So it's something to consider with it. Next slide. Again, the key for looking at LIFO this year is inflation. Everybody's seeing inflation, both at the grocery store, the gas pump, but companies, manufacturers, distributors, retailers are seeing inflation in a number of products, supply chain issues or tariffs or whatever it is. Prices are up, and we've seen significant inflation for some companies, not only 5–10%, but some cases 40 or 50%. Again, anytime somebody mentions that they've seen higher prices with it, LIFO should be one thing that they look at. Because again, it can provide a significant tax benefit for them. One thing just to note on that prior slide here, just is if you go to the LIFO method, there's one provision, what they call is the LIFO conformity. If you use it for tax purposes, you also have to use it for book purposes. So again, it's one of the few areas of the tax law which requires the book and tax to be the same. Okay, one thing with the LIFO that we've seen and done with some companies is what they call this IPIC or IPIC method, which actually uses government inflation factors to come up with your inflation, not the actual inflation a company may have. In some cases, those inflation factors might be even higher than you're experiencing. You get to use those. Again, it's a complicated process, but it may be worth the extra effort to go through that. Okay, the next thing, again, last thing here with it, again, there's a special form you have to do. It's not a 3115 to do a change of method. You do a 970. It's called the adoption of LIFO with it. It's an involved process that you'll have. Again, you need to go through that. There is some extra cost that you have not only in the initial year, but in subsequent years doing your LIFO calculations, but it may be well worth it to go ahead to do that. For those, again, I mentioned that you have this conformity requirement. If you've got debt covenants that are based on your, let's say, your working capital, you can get those and work with your banker to put those on a FIFO basis. So even though you have to use LIFO in your financials, you can still get your debt covenants to be written on a FIFO basis. Or if you've got bonuses for your employees, again, you can still do those on a FIFO basis. So you don't want to have any detriment internally toward going ahead to getting LIFO and get the tax savings with it. So I encourage you, any companies out there that haven't looked at LIFO, there's something that you can do. You can adopt up to when you file your return here for 2022. It may be well worth it. We've had a number of significant opportunities with that over the last year with higher inflation. But again, once you do that, we can't go back and get last year's inflation. We can at least get the current year and going forward. Another item to look at is with inventory, sort of a little different with that, is some write-offs. Again, some companies this year, some companies, are having, lower inventory levels. Others maybe have built up their inventories. Maybe they have excess inventories, and maybe even some. So they might have to do a reserve on their books for some of their inventory. Generally, a reserve is not deductible for tax purposes. Generally, you have to dispose or physically dispose of the inventory to get a tax deduction for it. Another way to get a write-down is if the thing has declined in value and it's less than your cost, so let's say the market is less than the cost, and if you offer it for sale at that reduced market value within 30 days of the end of the year, you can get a write-down for tax purposes. So something to take a look at if you do have some inventory that has declined in value that you still hold. If you do offer it for that reduced price, you can get a write-down. That's something that you'd want to start looking at, now before the end of the year instead of waiting too long with it. So anyway, some things to keep in mind with inventory, both the LIFO and some of these other write-offs. I'll turn it over to Glenn here now.
All right, thanks, Jim. Appreciate the thoughts on inventory. Lots of good ideas there with LIFO and write-downs. So, hey, I think we can't have a webinar without talking a little bit about the employee retention credit. So, just bringing back old memories here. So we do still think there's opportunities for the ERC, particularly in 2021 when some of the rules were lessened. Just as a brief reminder, we have kind of two ways to qualify. One is a very objective way, did I have a reduction in gross receipts, and those percentages changed over time. And the other way is the subjective way. This kind of, am I impacted? Was I, fully or partially suspended due to a government order? And that's the one that's, I think I called it, Tom, the squishy one, I believe. So I believe that was my term.
I think that was the technical term you did use. Yeah.
So we're going to talk a little bit more about this. There is still been a pretty long wait to get these credits. You generally file 941X. In some cases, some of our clients have gotten these in, 2-3 months. Some cases it's been 9+ months. So we can't really make rhyme or reason about it. And do remember that the ERC is, it is treated as taxable income. You must reduce your wage expense, and that certainly, potentially means you have to actually go back and amend your return if you've already, filed your 2020 or 21 return, which I hope you have by now. Okay, so what's the latest news? I think it was October 19th. I think the IRS came out with a warning, just telling taxpayers in general, hey, be careful. There's, third-party providers out there who are taking some, what the IRS thinks is aggressive positions, in particular in regard to the government order. So we do understand, and we've had, some conversations with a number of people, that they are beginning to look at doing audits. They actually are starting to do ERC audits. They're basically gearing up to make this a focus here in the next few months. So we certainly think there'll be more scrutiny in the coming months and years. Just as a reminder, there's still time. How long do we have to claim, a refund? How long do we have to file a 941X? I think it's longer than you think, and that's why I wanted to put it down there. For 2020 ERC claims, it's April 15th of 24, and for 2021, it's April 15th of 25. So that it doesn't matter when you filed your second quarter of 21. It's not based on the second quarter due date of the 941. It's April 15th. It's really tied in with the 1040 due date, so there is still time. Another little item here is the statute of limitations. How long does the IRS have to go look at these? They did make a change starting in the third quarter. It's going to be 5 years instead of the 3 years. It would also apply in the fourth quarter if you were doing the startup ERC. But in general, it's really only going to impact one quarter, being the third quarter of 21. We just want to make sure people, have the documentation. If you're using these firms or if you're using us to help, you just want to make sure you document things because again, we think there's a high likelihood that you're going to be in that audit lottery. And I believe in the handouts, there's going to be handouts about a recent 3-parts article series that Sikich prepared here on ERC. So, we want to just keep you informed of this. Just know that there's some risk out there. But again, we do think there's opportunity to still be able to claim this employee retention credit.
Okay, thanks, Glenn. Wanted to just briefly touch on the brackets. IRS did release a lot of 2023 tax brackets, pretty significant increases in a lot of these. I won't go through each one, but just know that, inflation, the high inflation rates we've been experiencing have impacted. As you can see, almost $1 million, about halfway down there, about $1 million increase in the estate tax exclusion. The gift tax exclusion's up. The Social Security wage base. I think for married filing jointly, the highest bracket, the 37% bracket it's almost to 700,000. So these brackets really went up. In theory, if your income didn't go up with inflation, you're getting a tax break because the brackets are higher and you'll pay tax in some of the lower brackets. So just be aware of that. And I think there's an IRS notice out there that I don't know if we listed that or not here, but you can kind of peruse that and see. The other planning idea, which I think there's still a lot of folks that don't understand the power of the health savings account. So health savings accounts, they're referred to by some as a sort of triple tax free, right? So you put dollars in there at a pre-tax. There's tax-free growth, and then if you use the dollars correctly for qualifying expenses, either current or past, there's tax-free distribution. So it's a really, really, probably in my opinion, one of the most powerful tax planning tools you have, and especially for some of folks that are 20, 30 years from retirement. If they start funding an HSA now, they really are going to have a nice savings account, an IRA, much more powerful than an IRA. So to qualify, just to give you kind of a brief overview here, you got to be in a high deductible health insurance plan. In 2023, minimum deductible is $1,500 or $3,000 married filing jointly. There is a max on those deductibles. I believe it's about $15,000 for married filing jointly. So it's got to be a high deductible plan, right? Contribution limits, $7,750 for family in 2023. And then there's a catch-up contribution if you're 55 or over. You get an extra $1,000. So a couple things that maybe folks don't realize is there's this rainy day fund option, right? So you continue to fund your HSA year in, year out, and then you retain all of your out-of-pocket expenses that you paid outside of HSA dollars. So you're paying these expenses with after-tax dollars. You keep those receipts. You now have what I call a rainy day fund, right? You can reimburse yourself for those expenses tax-free at age 65. So it's kind of a little bit of a rainy day fund for you. But I think the bigger thing is most folks can't use the medical, they can't deduct medical expenses as a itemized deduction because of the 7.5% floor based on AGI. So this is really a kind of an alternative to that. So you're using pre-tax dollars to pay things like Medicare premiums, COBRA premiums. You can actually pay long-term care premiums subject to certain limits with HSA dollars. Something pretty interesting, a loophole here. If your child is on your health plan and they're not a dependent, right? So they've graduated, typical scenario, they're out in the workforce, maybe graduated from college, but they're still on your health plan. They're under the age of 26. They, as an individual, can contribute $77.50. It's kind of a loophole, but know that kids on your plan that aren't a dependent can make their own HSA contribution. So kind of an interesting little loophole. And spouses can use funds for other spouse medical expenses. So one spouse is contributing to an HSA, those funds can be used for either spouse's medical expenses. So HSAs are a very powerful tool. Kind of get up to speed on those, talk to your advisor. And now we're to poll question number 3, Jim.
Okay, thank you, Tom. A good review of the HSA plans. Our third polling question, third and last one. Are you going to do any tax planning before year end? Again, that's part of the focus of this webinar today, but we just want to see yes, no, or unsure, and just get your responses with that. Again, that could be you individually or your business or a combination there. So again, please answer the poll question here.
A little Jeopardy music maybe would be helpful.
Yeah, John, why don't you speak for us, Tom? Maybe we could have that.
Well, I don't want to scare all of our audience away, so.
Yeah, that's true. That'd be a
that'd be bad.
trick or treat
Right.
with Tom singing for us here.
Right.
Okay, let's see how our results turned out for this third polling question. Yes, look at this, 84%, 4 no, and then a couple, 12% just unsure with it. So again, significant amount, again, looking at doing some year-end tax planning. Good, we appreciate the comments there with it. Let's turn it over for the home stretch here for Glenn.
All right, well, thanks, Jim. Yeah, I see we had a question here in the chat about, are there any reporting changes for 22 on the K2 and K3? And hey, that's going to be the next topic here. So I still see the poll results. I don't know if anyone else sees the same thing, but I'll get moving here. For those, I don't know if there is, the handouts are listed in the in the handout section of the webinar. So there is a PDF copy of the handouts. So yeah, I wanted to talk, just in the interest of time, I'm not going to really spend any time on this slide. Cryptocurrency, just know that there is a new question, kind of an expanded question on the 1040, now called a digital assets question. So we'll go to the next slide. Gig economy, again, we just want to kind of move through this pretty quick. There's a new very low threshold, $600 on a 1099K. But let's get to the following slide, because that's the question that one of our audience members asked about, is the K2, K3. So this, just came out last night. Tom had me stay up, all hours of the night putting this slide in. So what you got to do. Just came out yesterday, Form 1065, K2, K3 instructions draft. So are these going to change? Probably so, but it's at least what we have. And we'll stay on this slide, but on the next slide, I have the actual snips from the instructions, because I want to have it be very well memorialized what it originally said, because I'm guessing it might change down the road. So there is this domestic filing exception. So basically, how do we not have to file a K2 and a K3? 4 criteria. Well, the first one is kind of no or limited foreign activity. There's a $300, I believe, foreign tax credit kind of concept. There is, who are the partners? The partners primarily, these individuals. Are they all individuals? I believe if you have an S corp as an owner, a C corp as an owner, another partnership, I think you're out of luck. Don't quote me on that, but I believe that's the case. So that's kind of important. And then number 3 and 4 are really the new things. And there's this partner notification concept. So, for the business owners out there, we're going to basically have to communicate with our partners and ask them, hey, do you need this K2, K3? So the idea is you communicate 2 months prior to the original due date of the return, and then if no one responds in a month after that, then you're kind of off the hook. So let's do a quick example. And they do have 5 examples in the instructions, but let's do a quick example here. For a calendar year partnership, you basically would need to mail out the partner notification to all the partners by January 15th of 23. and you put in there something to the effect that, you know, hey, we're not going to send you a K3 unless you tell us otherwise, and you have a month to respond. And so then if no partner requests a K3 by February 15th of 23, you don't need to prepare one. So again, brand new information. I think it'll change. If you want to go to the next slide, Tom, here's more specifics. You can see it's never easy. There's a number of criteria that go into there, but I did put in the four criteria I snipped in there, and then this example 3 kind of talks about a little more specifically about how it would work. So again, just brand new info, but we wanted to get that out on the table. Yeah, we'll just skip this slide, Tom, in the interest of time, and let's get to our final idea being cash balance plans. It's a hybrid plan. It's an enhanced retirement plan. You can put more money away than a traditional 401k plan, as an example. It's a defined benefit plan ultimately, and the idea here is that if you have people who are nearing retirement, they're older, right? They're more highly compensated. You can put away a much larger contribution on their behalf, basically because their retirement is near, right? It's like, hey, I'm underfunded. In order to fund this, I've got to put in more money for the older and more highly compensated people. So, you can put away, $100,000 to $300,000, just as a rough range. You can get some pretty high numbers. Again, it depends on the income that the person is reporting and their age. Is this an opportunity to do this while the stock market is down? As Tom talked about earlier, with harvesting losses, well, this could be a concept of maybe this is a good time to invest in. Maybe it's a business owner that doesn't have much exposure to the stock market. It's a way to diversify. So just something to keep in mind. There are some, a lot of rules and regulations around it, increased cost and the complexity. But I do think it's something they should keep in mind, and it should be a tool in your toolbox for certain owners who are nearing retirement.
Okay, we have a few questions here. I don't know if we want to try to tackle any of these or not.
I saw a couple, Tom. Maybe we can a couple address these. Again, thank you for submitting the questions. And we'll get back to you on these too. But when I did see that somebody asked about LIFO, is that, if you have to be a C Corp to do LIFO, and no, it can be a C Corp, S Corp, or a partnership can elect or adopt LIFO with it. So, it doesn't matter what type of entity that you have with it, you can all take advantage of LIFO. So that was one question I did see that came in right at the end here.
Yeah. So some of the questions we will, there's a couple here. We'll provide responses after the fact. And we'll make sure we get those questions answered, but we want to be respectful of everyone's time. And Jim and Glenn, do you have any sort of closing remarks on any? Glenn, you were up late last night. Did anything come through on the internet that we didn't make it to the slides that you want to just talk about real quick?
No, I think, it's just important for everyone to, be thinking about tax planning and be a little more intentional this year. I think we're, maybe getting kind of caught up a little bit. Maybe we're not as behind, as business owners. And so let's, I think see a focus back to tax planning, with a couple months left here, and so that we're not chasing our tail. We can really look forward and be proactive, intentional in our tax planning.
Yeah, and I think, I'm sorry, Jim, I just mentioned documentation compliance, is going to become a more important issue. As you can see, things like K2, K3, and the cryptocurrency, all of these compliance requirements are really getting pushed down to those of us who are helping clients comply with the law, prepare the returns. And so there's increased, push down on compliance on the professionals that are doing returns. But then in addition, you can see the IRS has got new funding and new initiatives to sort of reinforce their systems and their workforce. So I do think that that's another theme that folks need to remember, is make sure that you've documented everything that you give to your tax preparer.
Great. Okay. I think that's important, the documentation. And important to get working on that year-end planning now to kind of estimate that and see where you stand, and then check on some of these new provisions that may happen. And one thing to keep in mind too, with some of the year-end planning that you have, I'll close with this, is to just keep an eye on Congress. Again, they may do some, lame duck session of Congress, may have some legislation that could fall into December, right when you're doing your final year-end planning, and make some changes that could affect what you're doing. So it's really hard to predict that, but keep that in mind as you're doing that, and we'll try to keep you posted as some of those developments come up out of Congress.
So with that, Jim, we do have 2 weeks from today a post-election webinar that's already on the books. We'll talk about the election and potential tax legislation before year end. So look for that. If you're interested in that, 2 weeks from today, there will be another program. So as a reminder, complete the survey, and that's required to get CPE credit. And also, we just want your feedback. We want to hear what's on your mind. So any unanswered questions, we'll get back to you on. And as I mentioned earlier, the session was recorded. It is being recorded, so it will be available on demand, as are all of our webinar recordings. And again, on behalf of Jim and Glenn, thank you very much for your attention today, and wish you a great day and a wonderful weekend. Thank you.
Thank you.
Thank you.